Implied volatility, referred to as IV, is a forecast of the likely move in the underlying price over the next year. IV is represented as a percentage that shows us the expected one standard deviation range for the next year. The one standard deviation range covers roughly 68.2% of all outcomes, so the IV represents the range that the underlying will be over the next year with a roughly 68% probability. As an example, let's imagine the underlying is trading at $100 and has an IV of 30%. The one standard deviation range would be $30 over the next year, so there is an implied probability that the underlying would be between $70 and $130 in a year. A shorthand calculation to find the market's expectation for price ranges tomorrow is the expected range is equal to plus or minus IV divided by 19.1. There is another type of volatility known as historical volatility. Historical volatility is the statistical volatility based on real past data. So the higher historical volatility, the more the underlying has moved in the past. In theory, past volatility can be a rough indication of future volatility, but it may not be accurate for making predictions for future volatility. An example of this is 2020, as the volatility in this year was nearly double the average historical volatility between 2010 and 2019. So if we would have tried to predict the volatility of 2020 using the past decade's historical volatility, we would have been very off. One reason that historical volatility is useful, however, is that volatility has a tendency to revert to the mean over the long term. And so most of the time, realized volatility comes in lower than implied volatility, which is why selling options is often profitable. IV factors into pricing options contracts because if the underlying is expected to make larger moves, then it costs more to get exposure to this movement. Let's think back to the insurance example when we talked about selling options. If the insurance company notices more people filing claims because of a recent string of natural disasters, the premium to insure your home would increase to cover the insurance company's risk associated with an increase in large-scale disasters. When it comes to options, it's a similar story. If the underlying is expected to make large moves over the next year, option sellers are going to demand a higher premium to be paid to help protect them from this risk. So, the higher the IV, the higher the price of the option contract. As volatility increases, the potential price range expands, so the option price gets more expensive. And as volatility decreases, the potential price range contracts, so option prices get cheaper. IV tends to increase around events that impact expectations for the future due to the uncertainty associated with them. These dates are known as binary events, and we will discuss examples of them and their impacts on options trading in more detail in the advanced section.